I'm from BitBoy Crypto. Welcome to our Advanced Crypto series. In today's lesson, we're gonna be exploring one of the most revolutionary concepts in blockchain technology, smart contracts. And these digital agreements are changing industries from finance to healthcare. By the end of this video, you'll know exactly what they are, how they work, and why they're such a big deal. Let's jump right in. Alright, welcome back to our Advanced Crypto series. In today's lesson, we're gonna be exploring one of the most revolutionary concepts in blockchain technology, smart contracts. And these digital agreements are changing industries from finance to healthcare. By the end of this video, you'll know exactly what they are, how they work, and why they're such a big deal. Let's jump right in. Section 1. What is a smart contract? So let's kick things off by addressing the big question, what is a smart contract? At its core, a smart contract is basically a digital agreement, kind of like a legal contract, except instead of being written on paper, it's written in code. Now this code gets stored on a blockchain network, usually Ethereum, and that makes it tamper-proof and transparent. But here's where things get really interesting. Smart contracts can automatically enforce the terms of an agreement without the need for a middleman like a lawyer or a bank. Let me show you an example to make this more clear. Imagine Alice wants to buy some art from Bob, who's an artist. Now normally in this scenario, they would have to go through a gallery, which would take a cut of the sale. But if both Alice and Bob are on a blockchain network and they agree on the price of the art, which let's say is 1 ETH, they can use a smart contract. So here's how it would work. Alice puts the 1 ETH into a smart contract. The contract then checks if she sent the full amount. If yes, it automatically releases the art to her. So in this case, the smart contract acts as the middleman, ensuring that both parties stick to the deal. This way, Alice doesn't have to worry about Bob running away with her money and Bob doesn't have to worry about Alice backing out of the deal. And the cool thing is that all of this happens without the need for a third party, making it faster and cheaper than traditional methods. Now, you might be wondering why should you use smart contracts over traditional methods like using a third party? Well, smart contracts offer several benefits. First, they're much faster. There's no waiting around for paperwork or for someone to sign off on a deal. As soon as the conditions are met, the contract executes the agreement automatically. Second, smart contracts are much cheaper. There's no need to pay lawyers or other middlemen. And finally, smart contracts are much safer. They eliminate the risk of fraud or tampering because the contract lives on a blockchain, which is a public and tamper-proof record. Okay, so now that we know what a smart contract is and why it's awesome, let's look at how it works. So let's break down how smart contracts actually function. At a high level, smart contracts are essentially programs stored on a blockchain that can do pretty much anything you want them to do. For example, think about a vending machine. You put in the coins and then you press a button. Then the vending machine automatically dispenses your snack. Similarly, smart contracts are designed to automatically carry out the terms of an agreement when certain conditions are met. Under the hood, smart contracts are written using special programming languages specifically designed for blockchains. One of the most popular ones is Solidity. Solidity is a high-level programming language developed specifically for writing smart contracts on the Ethereum platform. It combines aspects of popular languages like C++, Java, and Python into a language that is tailored for blockchain applications. So how does Solidity and other languages work in a smart contract? Well, let's continue with our vending machine analogy. We could write a set of rules or code in Solidity, something like if the customer inserts the exact amount of money then dispense the snack. These rules are then compiled into code that runs on the Ethereum virtual machine or EVM. The EVM is basically a virtual computer that runs the code of smart contracts on the Ethereum network. So in our vending machine analogy, the EVM would check if the customer inserted the correct amount of money. If so, it would release the snack. If not, it would do nothing. Now let's bring this back to blockchain. So when we upload our code to the blockchain, it gets stored as a bytecode, which is basically machine code that the EVM can understand. And then this bytecode is executed by the EVM. Now this process ensures that the code runs exactly as intended and prevents any tampering since the code is part of the blockchain. And speaking of the blockchain, that's where the magic of smart contracts truly shines. When deployed onto a blockchain, smart contracts enjoy some incredible benefits. First, they're transparent. Since the blockchain is public, anyone can view the contract and see exactly how it works. Second, they're immutable. Once a smart contract is deployed onto the blockchain, it cannot be altered or removed. This means that the terms of the agreement are final and cannot be changed, which helps ensure that both parties stick to the deal. Third, they're autonomous. Smart contracts don't need any middlemen like lawyers or banks to enforce their rules. They execute automatically when the predefined conditions are met. And finally, they're secure. Because smart contracts live on a blockchain, they benefit from the same security features that make cryptocurrencies so secure, things like decentralization and cryptography. So overall, these unique characteristics of smart contracts make them incredibly appealing compared to traditional contractual agreements. So let's talk about some real-world examples of smart contracts in action. The possibilities are really endless, but let's cover a few sectors where smart contracts are making waves. First, finance, aka DeFi. Smart contracts are driving the DeFi revolution. They enable decentralized exchanges where people can trade cryptocurrencies directly with each other without needing a middleman exchange. They also make lending and borrowing crypto possible, allowing individuals or even businesses to lend their crypto and earn interest or borrow crypto by putting up their crypto as collateral. Next, real estate. Smart contracts are transforming how we buy, sell, and manage property. With fractional ownership, you can break down properties into smaller units, which can be sold as tokens on the blockchain. This allows more people to invest in properties and potentially makes the process faster and more efficient. Moving on to healthcare. Smart contracts can help solve some major issues like interoperability and data privacy. Imagine a system where patients control their own health data and decide which doctors or hospitals can access it. Smart contracts could also streamline clinical trials by automatically verifying patient eligibility and securely sharing data among participants. Supply chains. Smart contracts can track products from their origin to their destination, providing transparency and accountability at every step. This can help prevent counterfeit goods and ensure that products meet safety standards. And finally, voting. Smart contracts can make elections more transparent and secure, reducing the risk of fraud and manipulation. Voters can cast their ballots directly on the blockchain, and the results can be immediately verified. So now you might be thinking, awesome! What are the limitations or risks of smart contracts? First, coding bugs. Just like any software, smart contracts can have errors in their code. And if these bugs are exploited, it could allow bad actors to manipulate the contract or steal funds. Next, no flexibility. Once a smart contract is deployed on the blockchain, it cannot be changed. This means that any mistakes or changes that need to be made require creating a new contract. Legal gray areas. In many countries, smart contracts aren't legally recognized, which creates uncertainty about how courts might view them in case of disputes. Oracles. Many smart contracts rely on external data sources called oracles to make decisions. If these oracles are hacked or manipulated, it could throw off the entire contract. So in conclusion, smart contracts are a groundbreaking innovation with the potential to revolutionize numerous industries. They offer a secure, transparent, and efficient way to automate agreements, removing the need for middlemen and reducing the risk of fraud. However, it's important to be aware of their limitations and potential risks, including coding errors, legal uncertainties, and dependence on external data sources. As smart contracts continue to evolve, it's crucial for developers and users to prioritize security, conduct thorough audits, and stay informed about best practices. So that wraps up our deep dive into smart contracts. We've covered their definition, how they work, their benefits, and some of the challenges that come with them. If you found this lesson helpful, don't forget to hit the like button and share it with your friends. Subscribe to our channel for more videos like this and join our awesome community on social media. Keep learning, keep exploring, and stay curious. Thanks for joining us on this journey through the world of smart contracts. Until next time, happy contracting! Hey, welcome back to our Advanced Crypto series. Today, we're diving into the world of DeFi, decentralized finance. This is where banking meets blockchain. And by the end of this video, you'll be armed with the knowledge of how DeFi works, what lending, yield farming, and liquidity pools are, and why they matter for the future of money. So buckle up and get ready to demystify DeFi. Let's dive right in. First up, let's cover the basics. What is DeFi? Well, DeFi stands for decentralized finance. Now don't let the name fool you. It's not about some new kind of cryptocurrency. Instead, it's a whole new way of thinking about traditional financial services. So what does that mean? Essentially, DeFi is a financial system built on blockchain technology. Imagine a world where there are no banks or middlemen involved in your financial transactions. That's what DeFi is all about. Instead, it uses smart contracts to handle everything from lending money to trading assets. These smart contracts are basically pieces of code that automatically execute when certain conditions are met. For example, if you want to lend some cryptocurrency, a smart contract can automatically manage the terms of the loan, ensuring that both you and the borrower stick to the agreement. So how does DeFi actually work? Well, it's based on a few key concepts which we will discuss in a moment. But first, let's talk about why DeFi even exists. After all, we already have banks and financial institutions. Well, the idea behind DeFi is to create a more open, efficient, and user-friendly financial system. With DeFi, anyone with an internet connection and a crypto wallet can access financial services regardless of their location or background. No more worrying about bank opening hours or waiting for a response from a customer service representative. With DeFi, it's 24/7 and completely borderless. But there's more. DeFi aims to cut out the middlemen, those financial institutions that traditionally handle many of these transactions, and take a cut along the way. By using smart contracts, DeFi can automate many of these processes, reducing the need for intermediaries and their associated fees. Additionally, DeFi promotes transparency. All transactions are recorded on the blockchain, a public ledger that anyone can view. This helps build trust and accountability, making the financial system more equitable for everyone. Now let's dive into the key concepts behind DeFi, starting with lending and borrowing. With DeFi, you can lend or borrow cryptocurrencies or other digital assets without going through a bank. When you lend, you provide funds to a DeFi protocol which then lends them out to borrowers. In return, you receive interest payments based on the amount you have lent. Similarly, if you want to borrow, you can do so using your digital assets as collateral. This process is made possible by something called a collateralized debt position, or CDP. Let me explain. Suppose you want to borrow some money. With a traditional bank, they would assess your creditworthiness, looking at your income, credit history, and other factors to determine whether or not to approve your loan and the interest rate you would pay. But with DeFi and CDP, things are a bit different. Instead of relying on your credit history, DeFi uses your collateral to secure the loan. This means you can still borrow funds even if you have a poor credit score, as long as you have valuable digital assets to put up as collateral. The value of your collateral must exceed the amount you borrow to reduce the risk for the lender. If the value of your collateral falls below a certain threshold, you could be liquidated, meaning you lose your collateral to repay the loan. But that's a topic for another day. Another important concept in DeFi is yield farming. It's pretty much what it sounds like. You farm for yield, you harvest the yield. But here's the twist. Yield farming involves lending your digital assets to various DeFi protocols to earn interest or rewards. But that's just the beginning. Yield farmers take things a step further by moving their assets across different protocols to maximize their returns. For example, you might lend your assets to a decentralized exchange or liquidity pool to earn fees and then use those earnings to buy governance tokens of that exchange. Those governance tokens give you voting power and the right to receive a portion of the platform's profits. By doing this, you've diversified your income streams and potentially boosted your overall returns. But yield farming isn't for the faint of heart. It comes with its own set of risks, including smart contract bugs, price volatility, and the possibility of getting rugged. More on that later. Now let's talk about liquidity pools. Imagine a marketplace where you can swap one cryptocurrency for another without having to wait for a buyer on the other side. Sounds too good to be true, right? Well, it's possible thanks to liquidity pools, a unique feature of DeFi. Liquidity pools are essentially smart contracts that allow users to trade digital assets directly from a pool of funds. Let's say you want to buy Ethereum using Tether, a popular stablecoin pegged to the US dollar. You connect your wallet to a liquidity pool like Uniswap and enter the amount of Tether you want to spend. The protocol then uses its reserves to automatically sell you the equivalent amount of Ethereum. It's like having your very own personal exchange. But how do these liquidity pools work? Well, they're made possible by individuals who contribute their funds to the pool. By providing liquidity, these individuals known as liquidity providers earn fees from each transaction that takes place within the pool. The cool thing is you don't need to provide exactly half of the funds for the pair. You can contribute whatever amount you want as long as it maintains the correct ratio of assets within the pool. So if the pool requires equal amounts of both assets, you could add just enough of your holdings to maintain that balance. But keep in mind that the more liquidity you provide, the greater your potential rewards. However, it's essential to understand that there's a risk of impermanent loss, which occurs when the value of one asset in the pool increases significantly relative to the other. One of the most significant benefits of DeFi is its potential to offer higher returns compared to traditional finance. This is due to a couple of factors. First, DeFi platforms often pass on the savings they generate by eliminating middlemen like banks. They can offer more competitive rates to users. Secondly, DeFi thrives on innovation. New platforms and applications are constantly emerging, bringing fresh ideas and features to attract users and offer better deals. This competition drives the industry forward and ultimately benefits users. But keep in mind that higher potential returns usually come with higher risks. You should always thoroughly research any DeFi platform before getting involved. And now let's talk about a critical aspect of DeFi, its transparency. All DeFi platforms operate on the blockchain, meaning every transaction is publicly viewable. This level of transparency promotes trust and accountability among users. If a platform is not behaving fairly or sustainably, it's likely to be called out by the community. Additionally, many DeFi platforms allow users to participate in governance by staking their tokens. This gives users a say in the direction of the platform and helps ensure that decisions align with the best interests of the community. Now, while DeFi offers numerous benefits, it's essential to be aware of the risks involved. One major concern is smart contract bugs. Since DeFi platforms operate through code, vulnerabilities in these smart contracts can create security risks. Exploits and hacks can occur, leading to the loss of funds. For example, in 2020, a flash loan attack on a DeFi protocol resulted in millions of dollars in losses. It is crucial to stay informed about the security of any platform you use and to be cautious about new or unproven platforms. Another risk to consider is impermanent loss. We touched on this earlier, but it's worth emphasizing. When you provide liquidity to a pool, the value of your assets may decrease over time due to market fluctuations. Unlike permanent loss, which is a real economic loss, permanent loss only lasts as long as the assets remain in the pool. However, if market conditions don't turn around, it can quickly become permanent. Finally, let's talk about scams and rug pulls. Unfortunately, the world of DeFi has seen its fair share of scams and rug pulls where the creators of a project abandon it, taking investors' money with them. Always conduct thorough research, read smart contracts carefully, and be wary of projects that promise unrealistically high returns. In conclusion, DeFi is revolutionizing the financial world by offering decentralized, transparent, and potentially more rewarding services. From lending and borrowing to liquidity pools and yield farming, DeFi provides innovative ways to interact with digital assets. While there are risks to consider, the benefits of this technology cannot be ignored. As DeFi continues to evolve, it will be interesting to see how it shapes the future of finance, making it more inclusive and accessible for everyone. Before we wrap up, make sure to smash that like button and subscribe for more crypto insights. And if you haven't already, check out our previous videos in the series to level up your crypto game even more. Until next time, happy trading and stay savvy. Welcome back to our Advanced Crypto series. So far we've demystified topics from wallets to stablecoins. And today, we're diving into a crucial aspect of crypto governance tokens and decentralized autonomous organizations or DAOs. Who really holds the reins in this decentralized world? Join us as we break down the mechanics of voting power, explore real-world examples of DAOs in action, and discuss the benefits and challenges they bring. Plus, stick around to the end because we've got some exciting news to share. Alright, let's get into it. In the traditional corporate world, decisions are made at the top by a board of directors or executives. But in the world of crypto, there's no single boss. So, who decides what happens in decentralized projects? The answer lies in governance tokens and DAOs. But first, what exactly is a governance token? Simply put, a governance token is a type of cryptocurrency that gives holders the right to vote on important decisions within a project. Let's imagine a scenario. You're a user of a popular crypto exchange. As a governance token holder, you gain the ability to vote on changes that impact the platform, such as adjustments to trading fees, security measures, and even the addition of new cryptocurrencies. Your voice matters because each token you own represents a share in the decision-making process. Projects like Uniswap, Maker, DAO, Compound, and many others use governance tokens to distribute power among the community. Now here's the key point. The more tokens you hold, the more voting power you typically have. However, there are also systems that allot each user an equal vote regardless of how many tokens they own. And speaking of voting, did you know that the concept has its roots in ancient Greece? Athens introduced a system where citizens could vote directly on laws, laying the foundation for modern democracy. Now let's talk about something that governance tokens enable: decentralized autonomous organizations or DAOs. Think of a DAO as a digital cooperative run by the community and governed by rules written in code. There's no need for a central authority when you have smart contracts that automate decision execution. So what is a DAO? A DAO is like a digital cooperative where members collaborate towards shared goals. But unlike traditional organizations, DAOs have no hierarchy and no central authority. Here's a closer look. A DAO is a community of individuals who come together with a shared purpose. These purposes can range from creating new cryptocurrencies to building decentralized applications or investing in various crypto projects. For example, a DAO dedicated to art might pool funds to purchase NFTs while another focused on finance could invest in promising DeFi protocols. Now members join a DAO by purchasing a unique token. This token often serves as a membership card granting them certain rights and privileges within the organization. And the cool thing is anyone in the world can join a DAO as long as they acquire the necessary token. Let's take MakerDAO as a prime example. MakerDAO is a renowned DAO that focuses on developing and maintaining the DAI stablecoin. It allows developers to create new cryptocurrencies. Aave is another notable example with its DAO controlling upgrades to the popular lending and borrowing protocol. Then we have Decentraland, which uses a DAO to manage the rules and evolution of a virtual world where users can buy, sell, and experience virtual land. Now let's see how governance actually works in practice. Let's start with a problem. High gas fees are making transactions expensive. Now a solution is proposed by a community member. Lower transaction fees would encourage more users to interact with the network. Great idea. Next comes discussion. The proposal is posted on the project's forum, and community members start debating the pros and cons. They talk about the potential risks, benefits, and any challenges that might arise. This phase is all about getting feedback, addressing concerns, and refining the idea. Once the discussion reaches a satisfactory point, it's time to vote. Eligible token holders review the proposal and cast their votes. Some might support it, others might oppose it. The beauty of this process lies in its inclusivity. Any token holder can participate and make their voice heard. Remember, in most cases, the tokens you hold give you voting power proportional to your stake. After the voting period ends, the votes are counted and the outcome is announced. If the proposal wins, it's time for execution. This is where smart contracts come into play. They automatically carry out the agreed-upon changes based on the majority vote. In our example, the smart contract would adjust the transaction fee parameters as per the community's decision. In essence, this process ensures that major decisions affecting the project are made collectively by those who have a vested interest in its success. Now let's explore why decentralized autonomous organizations or DAOs are gaining traction. First, decentralization. They embody the true spirit of decentralization by removing the need for a central authority. Instead, they distribute power among the community, allowing decisions to be made collectively. Second, transparency. All votes, decisions, and transactions are recorded on the blockchain, a public and transparent ledger. This openness allows anyone to track and verify the decision-making process, fostering trust and accountability. Third, community empowerment. DAOs give users a sense of ownership and empowerment by enabling them to shape the direction of the project. This active participation leads to a stronger sense of community and encourages greater engagement. Fourth, global participation. DAOs know no geographical boundaries. Anyone in the world with an internet connection and a desire to participate can join a DAO and contribute to its mission. This inclusivity fosters a diverse range of perspectives and experiences. However, along with the benefits come challenges and risks. First, whales dominate. Big token holders or whales can wield significant control over decisions, potentially leading to outcomes that benefit them at the expense of smaller token holders. Second, low participation. Many users may not actively participate in voting, leading to decisions that reflect the opinions of only a small portion of the community. Third, security risks. If a malicious proposal gains enough support and passes, it could compromise the security of the project or its users. Fourth, legal uncertainty. Regulators are still working to understand how to classify and regulate DAOs, creating a climate of uncertainty that could hinder their growth and adoption. Despite these challenges, the potential benefits of DAOs are driving innovation and experimentation across various industries. As the technology matures and best practices emerge, we can expect DAOs to become more secure, inclusive, and impactful. In conclusion, governance tokens and decentralized autonomous organizations are reshaping the way we think about decision-making and control in the digital age. They offer a glimpse into a future where communities can shape the direction of projects without the need for centralized authorities. As we continue to explore the world of crypto, we invite you to join us in shaping this exciting frontier. Your participation matters. Together, we can drive innovation, build trust, and create a more decentralized future. Speaking of the future, we have some exciting news to share. Our platform is launching a brand new feature called the Blockchain Game Hub. It's your gateway to the hottest blockchain games in the crypto world. And to celebrate this launch, we're giving away an epic prize pool worth $25,000. You heard that right, $25,000 in prizes. To participate, simply visit the Game Hub, play any of the featured games, and complete missions to earn points. The more points you accumulate, the higher your chances of winning. It's a fantastic opportunity to immerse yourself in the thrilling world of blockchain gaming and stand a chance to win amazing prizes. So head over to the Game Hub now and let the adventure begin. If you found this video informative, give it a thumbs up and subscribe to our channel for more in-depth crypto content. And if you want to dive deeper into the world of crypto, we've got a special treat for you. Check out our advanced crypto guide. It's packed with valuable insights that will elevate your understanding of crypto to the next level. Click the link below to access this exclusive guide. Trust me, you don't want to miss it. And if you'd like to learn more about the technical aspects of DAOs, we've included a link to a detailed technical paper by the pioneering organization, the DAO. Hello and welcome back to our Advanced Crypto series. If you're new here, consider subscribing for updates on all things crypto. And if you missed episode 1 of this series, check out our video on decentralized finance for beginners. Now let's get into today's topic, crypto laws and global adoption. Where are we headed? But before we do, let me give you a quick update. Now back to our topic. Since its inception, cryptocurrency has been considered a borderless technology free from government interference. Yet despite its decentralized nature, regulators worldwide have been working tirelessly to develop rules that would allow them to exercise control over this emerging industry. From taxes to anti-money laundering, securities regulations to consumer protections, there are several aspects of crypto that lawmakers are trying to rein in. But why is this the case? What are some of the most notable developments in crypto law so far, and what impact will they have on the wider adoption of crypto? Stay tuned to find out. Why does regulation matter? Before delving into specifics, it's essential to understand why regulation matters. Cryptocurrency started as a way to restore control over money to the people, cutting out middlemen like banks and governments. However, the two sides aren't mutually exclusive. While extreme decentralization is possible, it is also true that mass adoption will likely only come when people feel protected and secure enough to invest their hard-earned cash. Regulators, on the other hand, face the challenge of controlling criminal activities such as tax evasion, terrorist financing, and market manipulation without stifling the innovation and entrepreneurship that are core to the industry's success. That's why the goal isn't necessarily to crush crypto, but to strike a balance between protecting investors and enabling businesses to thrive. This involves creating a system that prevents fraudulent activity without stifling innovation or imposing unnecessary burdens. Regulation can also help build trust among consumers, leading to greater confidence in the market and broader acceptance of cryptocurrencies and blockchain technology. How are countries treating crypto? With that in mind, here's how some of the world's largest economies treat crypto. United States, crypto is legal in the U.S., but subject to taxation like any other form of income. Various agencies such as the SEC and CFTC classify certain tokens as securities or commodities, giving them specific legal status. Recent regulatory actions have focused on cracking down on scams, especially those involving celebrity endorsements. The SEC has also provided guidance on how certain cryptocurrencies should be reported for tax purposes. The U.S. is taking a tough stance on illicit activity and has even seized crypto assets linked to criminal activity. With the introduction of the infrastructure bill, which requires brokers to report transactions, the U.S. is aiming to increase compliance and ensure responsible usage. European Union, the EU has taken a more proactive approach. It recently introduced MiCA markets and crypto assets regulation. This legislation creates clear rules for stable coins, exchanges, and wallet providers. Focusing on transparency and consumer rights, MiCA aims to prevent market abuse and promote responsible innovation within the crypto space. China has taken the most aggressive approach. After banning crypto trading and mining, China has shifted its focus to developing its own state-backed digital currency, the digital yuan CBDC, laying the groundwork for a cashless society. El Salvador, in September 2021, El Salvador made Bitcoin legal tender, becoming the first country to do so. The move was aimed at boosting financial inclusion and making the country more attractive to investors. However, the strategy has faced challenges due to Bitcoin's price volatility and the country's limited resources. Nigeria. Nigeria has shown both support and resistance towards crypto. Despite a ban on banking activities related to crypto, it remains the most popular country for peer-to-peer Bitcoin trading in Africa. This highlights the growing interest in cryptocurrencies despite regulatory uncertainty. These examples show a mixed global picture. While some countries embrace and regulate crypto, others try to control it or outright ban it. Many more remain undecided and are closely observing developments. Central bank digital currencies (CBDCs). As we've seen, countries are taking different approaches to crypto regulation, but another common trend is the exploration of central bank digital currencies (CBDCs). A CBDC is a government-backed digital currency that runs on a blockchain-like system. Unlike cryptocurrencies like Bitcoin, CBDCs are not decentralized. Instead, they are issued and regulated by a central bank, retaining most of the features of fiat currency. The main difference is that they are stored and transferred digitally. Proponents argue that CBDCs can modernize payment systems, reduce costs, and even promote financial inclusion. Opponents worry about potential privacy violations, cyber risks, and the impact on commercial banks. China is leading the race with its digital yuan, having already piloted it in several cities. Other countries like the US, UK, and India are exploring CBDCs, recognizing the technological advancements and potential benefits. However, they are moving cautiously, considering the implications for privacy and financial stability. Only time will tell how CBDCs evolve and whether they'll coexist with private cryptocurrencies or replace them entirely. What are the barriers to global adoption? Despite positive developments in regulation, several barriers hinder global crypto adoption. Legal uncertainty. Clear laws are lacking in many countries, leading to confusion and hesitation among investors and businesses. Security risks. High-profile hacks and scams erode trust and make new users wary of the space. Volatility. Wild price swings make it challenging to use crypto for everyday purchases and discourage mainstream adoption. Energy concerns. The energy-intensive proof-of-work mining used by many cryptocurrencies raises environmental concerns. Drawing criticism from policymakers and the public. The future of crypto regulation and adoption. Looking ahead, several trends will shape the future of crypto regulation and adoption. Investor protection. Regulators worldwide will likely prioritize investor protection, introducing measures to prevent fraud, market manipulation, and other harmful activities. Stablecoin regulation. Stablecoins will face increased scrutiny due to their perceived risks to financial stability. Anti-money laundering measures. Expect stricter anti-money laundering and know your customer rules to curb illicit activities. Tax collection. Governments will work to ensure that crypto income is reported and taxed appropriately, potentially through collaborations with exchanges and other industry participants. Where will we be in 10 years? So what does the future hold for crypto regulation and adoption? Here are a few predictions. More regulation. Crypto will become more regulated, leading to greater certainty and investor protection. Coexistence with CBDCs. Crypto and CBDCs may coexist, each serving different purposes and catering to different user preferences. Growth of decentralized finance. DeFi could flourish, offering innovative financial services beyond traditional banking. Increased institutional adoption. More institutions will likely allocate a portion of their portfolios to crypto, driving further growth and legitimacy. In conclusion, the future of crypto regulation and adoption looks promising. As more countries develop clear legal frameworks, cryptocurrencies and blockchain technology will become more accessible and trusted by the general public. While challenges remain, the potential benefits of this technology are too significant to ignore. By embracing innovation and striking the right balance between regulation and freedom, we can ensure that cryptocurrencies and blockchain technology continue to thrive and benefit society as a whole. And in our next video in this series, we'll take a deep dive into advanced security. We'll cover topics like hardware wallets, multi-signatures, and cold storage. So hit the subscribe button now to stay updated. If you found this video helpful, give it a like. and share it with your friends. Your support means everything to us. Thanks for watching and see you soon. Welcome back to our Advanced Crypto series. In today's lesson, we're diving into one of the most critical topics in crypto security. You'll learn about hardware wallets, multi-signature protection, and cold storage. By the end, you'll know exactly how to keep your crypto safe from hackers, scams, and even human error. If you're new to the channel, consider subscribing so you don't miss any of our videos. Also remember to check out our free DeFi for Beginners guide by clicking the link below. Now without further ado, let's get started. Why does crypto need extra security? Unlike a traditional bank account where the bank protects your money and handles security, crypto is self-custodial, meaning you are responsible for securing your own funds. If your private keys are stolen or lost, there's typically no way to recover them or the money they control. And unfortunately, billions of dollars worth of crypto has been lost to hacks and mistakes. That's why it's crucial to understand advanced security strategies. A quick Google search will show you a variety of wallets from software to hardware options. So what makes a wallet more secure? Let's start with hardware wallets. They provide the highest level of security because they keep your private keys completely offline. Even if your laptop gets infected with malware or is physically stolen, the thief won't be able to access your funds. It's like having a safe deposit box at a bank but for your crypto. A hardware wallet is a small physical device that looks like a little computer. It stores your private keys offline, generating new addresses whenever you want to receive funds. To confirm a transaction, you'll need to plug the device into your computer or phone and physically confirm the details, then sign the transaction using the device. This ensures no one else can spend your crypto. Two popular choices are Ledger's Nano X and Trezor's Model T. They support major networks like Bitcoin, Ethereum, Cardano, and many others. And they also work with decentralized applications like Uniswap and MetaMask. However, these devices aren't compatible with everything. For example, certain specialized wallets may not work with hardware wallets, meaning you'll need to set up a separate software wallet for them. Here's a look at some other benefits of hardware wallets. They keep your private keys secure offline. They require physical confirmation for transactions, adding a layer of security. They offer compatibility with various coins and DeFi apps. They allow you to manage multiple accounts and assets. They provide offline signing of transactions for enhanced security. They offer portability and convenience. They are user-friendly. And they help prevent phishing attacks by keeping your keys secure. So what are some potential downsides? First, you have to handle an additional device which could lead to loss or damage. Second, they might be challenging for absolute beginners. Third, setting up a hardware wallet takes time and effort. Fourth, they might be too expensive for those just starting out. And fifth, in extremely rare cases, the device itself might be compromised. But overall, the pros outweigh the cons, and a hardware wallet is an essential tool for securely storing crypto long-term. Using a hardware wallet is easy. Just follow these steps. Choose a reputable brand like Ledger or Trezor. Set up your wallet according to the instructions. Create a recovery phrase and store it somewhere safe. Never share your recovery phrase with anyone. Verify your wallet using another device like your computer. Use the wallet regularly to keep your funds secure. If you want to dive deeper into hardware wallets, we recommend checking out our detailed guides on Ledger and Trezor linked below. Multi-signature wallets add another layer of security, especially useful for shared funds or businesses. Instead of one private key controlling a wallet, multi-sig requires multiple keys to approve a transaction. Let's say you set up a 2 of 3 wallet. At least 2 people would need to sign off before any funds could be moved. This helps prevent unauthorized spending and provides extra security. One person could hold one key, another person could hold the second key, and the third key could be stored securely offline. Even if one key is stolen, the funds will be safe. Many big companies and even crypto exchanges use multi-sig for added protection. You can easily set up a multi-sig wallet on most hardware wallets like Ledger and Trezor. Once set up, you'll have to coordinate with other parties to authorize any changes. While this adds security, it also means that you'll have to communicate with others each time you need to make a transaction. So if speed is important to you, a multi-sig wallet might not be the best option. Let's talk about cold storage. Basically, cold storage means keeping your crypto completely offline or disconnected from the internet. This offers the ultimate defense against online threats like hackers. Some examples include storing hardware wallets in a secure location like a fireproof safe, storing paper wallets with recovery phrases in multiple safe places, or even storing a computer with funds in an encrypted file disconnected from the internet. However, cold storage comes with its own set of challenges. If you lose access to your keys, whether it's the device or the written phrases, recovering them can be almost impossible. This highlights the importance of storing backups in different locations and having a plan in case you lose access to your funds. Cold storage works well for long-term goals since it keeps your crypto completely safe from internet threats. It's great for those who don't frequently trade or move their funds. But for frequent traders, the inconvenience of accessing funds might be a downside. Plus, if you store important documents or backup information electronically, it could potentially be affected by power outages or computer issues. So while it's the ultimate defense, it's not without its challenges. Alright, here are some golden rules for crypto security. Use hardware wallets for long-term holdings. These provide offline security and are essential for protecting your crypto over time. Consider multi-sig for shared or business accounts. Adding extra authorization adds a layer of protection and is useful for joint ownership. Store backups of recovery phrases in multiple secure locations. Don't rely on one copy. Have at least 2, preferably 3. Keep large funds off exchanges. Exchanges can be targeted by hackers. So store most of your crypto in secure wallets instead. Always double-check URLs. Phishing attacks often target crypto users. Be cautious and ensure you're on the correct website before entering any information. If you want to know more about staying safe in crypto, we've got you covered. Check out our dedicated video on crypto scams and how to avoid them. We'll teach you how to spot common traps and stay protected in the ever-evolving world of crypto. In conclusion, securing your crypto is essential, and a combination of hardware wallets, multi-signatures, and cold storage can offer robust protection. Remember, once you own crypto, you're responsible for its security. Losing your keys is like losing your bank account number and password forever. So take all the necessary precautions. Thank you for joining us in this video. If you found it helpful, please hit the like button and subscribe to our channel for more valuable content. And don't forget to check out our other lessons in the series. Links are in the description below. See you in the next video. Welcome back to our Advanced Crypto series. In today's lesson, we're talking about something every crypto user must know: scams. From fake investments to phishing attacks, scams steal billions of dollars every year. By the end of this video, you'll know the most common scams, how to recognize them, and most importantly, how to avoid becoming a victim. Let's dive right in. Crypto is still young, global, and often misunderstood. Combine that with the fact that transactions are irreversible, and you get the perfect playground for scammers. Remember, if you lose your funds to a scam, there's usually no way to get them back. That's why awareness is your strongest defense. Let's break down the most common scams. 1. Phishing scams. Fake emails, websites, or apps trick you into entering your wallet keys or seed phrase. Your private keys are like the password to your crypto wallet. If someone steals them, they can take all your money. Be cautious of suspicious emails, text messages, or phone calls asking for your private keys. Also watch out for fake websites that look similar to popular platforms but are actually controlled by scammers. These are called phishing attacks because scammers are trying to fish for your private keys. Always double-check the website address to make sure you're on the right platform. For example, if you're logging into a messaging app, make sure the web address starts with HTTPS and shows a lock icon indicating a secure connection. You can also hover over any links in messages to see where they go before clicking. If it doesn't match the expected website address, don't click. And finally, never use public computers or networks like those at libraries or cafes when dealing with your crypto assets. Instead, use a secure home Wi-Fi network or a virtual private network VPN for an added layer of protection. No. 2. Ponzi and pyramid schemes. Have you ever heard of a friend making tons of money in crypto and they say the only thing you need to do is to invest some money into a fund managed by them and they will return huge profits? Well, chances are that's a scam. These schemes promise crazy returns, like 5x your money in a month, which is just not possible in a normal market. They pay off early investors with funds from new investors, which makes it seem legit, but it's all an illusion. When new investors stop joining, the scheme collapses, leaving latecomers with big losses. Think of it like a house of cards. It looks stable from a distance, but it's all falling down. The most famous crypto Ponzi scheme is OneCoin, which is said to have defrauded investors out of more than $4 billion. Stay sharp and remember, if it seems too good to be true, it probably is. No. 3. Fake giveaways and airdrops. Scams promising free crypto if you send a small amount first. It might seem hard to believe, but many people fall for this trap every year. Even celebrities get scammed this way. The most recent example is NFL star Rob Gronkowski, who lost $5 million to a similar scam. The promise of free money is too tempting, but it's a lie. Don't ever send cryptocurrency to someone else's wallet hoping to receive more in return. No legitimate project will ask you to send money to get money. And remember, even if the person behind the scam has a big following, it doesn't guarantee authenticity. Many scammers impersonate well-known people like Elon Musk or Vitalik Buterin to trick you into sending them money. Always double-check any account you're dealing with and make sure it's legitimate. Number 4. Impersonation scams. Fake accounts pretending to be Elon Musk, Vitalik Buterin, or even official exchanges like Binance or Coinbase. These scams often happen on social media platforms, direct messaging apps, or websites. Impersonators might offer giveaways or investment opportunities to gain your trust, and then try to steal your money. Always verify official accounts through their official websites, not through social media. Legitimate organizations won't contact you first. If you want to reach out to them, make sure to visit their official website and not a third-party link. No. 5. Rug pulls and fake tokens. These are 2 tricks that developers use to make money by hyping up a new coin and then selling it to unsuspecting investors. A rug pull happens when the creators of a project sell their coins and then run away with the money, leaving the investors holding worthless tokens. On the other hand, fake tokens are created with the intention of deceiving investors. They usually have no real purpose and are only meant to make the scammers money. Some telltale signs of a rug pull or fake token include low liquidity, meaning the coins aren't easily tradable, or a lack of information about the project or its creators. For example, a fake token might not have any white paper or team information on the website. Before buying into any new coin or project, always do your research and read the project's white paper if available. Check if the liquidity is locked, meaning the creators can't suddenly sell their coins and run away. No. 6. Malware and wallet drainers. This is a type of scam where you download fake wallet apps or click on malicious links that automatically transfer all your funds to scammers. Usually this happens when you download apps from unofficial sources or click on suspicious links in messages. To prevent this from happening to you, always use official apps from reliable sources and double-check any links in messages before clicking. For example, if you receive a message with a link that looks like it is from a friend but the name doesn't match, it's probably a scam. There are many more types of crypto scams, and they come up with new ways to trick people all the time. But the ones we've talked about in this video are some of the most common. The good news is that if you stay informed and follow best practices, you can keep yourself safe. So let's talk about how to protect yourself. First, never, Ever share your private keys or recovery phrase with anyone? Your private keys are like passwords to your crypto wallet. If anyone else knows them, they can access your funds. Second, always double-check websites and apps before you log in. Make sure you're on the right platform before typing in any personal or financial information. Third, avoid clicking unknown links or downloading shady apps. If it looks suspicious, don't click it. Fourth, research before investing in new coins or projects. Don't fall for hype alone. Fifth, use hardware wallets for long-term storage. Hardware wallets are physical devices designed to keep your crypto safe. And finally, trust your instincts. If something feels off, walk away. Sometimes your gut feeling is right. In summary, crypto scams are everywhere, but so are warning signs. If you stay alert, do your research, and follow security best practices, you can protect your money and peace of mind. The key takeaway is simple: in crypto, you are your own bank, so you must also be your own security guard. This wraps up Level 3 Advanced in Depth. Congratulations, you're now equipped with the knowledge to navigate the deeper world of crypto safely. Next, we'll move into Level 4 Expert Mastery and Innovation, where you'll learn how to evaluate projects, build dApps, and even design your own blockchain ideas. We're here to guide you every step of the way. Stay tuned.